Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. We'll also take a brief tour through our core list of companies, and if you stick with me towards the end of the video, I've got 3 additional trade ideas I want to share with you, so definitely stay tuned for that. Obviously, this is coming out on Tuesday because keep in mind, the market will be closed on Friday in observance of Good Friday. So with that being said, let's jump right into our S&P analysis, starting things off with the sectors, as we always do. Who was leading, who was losing, and where was the weight? The energy sector led the pack today. XLE up 1.66%. Even if you want to calculate it based on today's open, the utility sector would have technically taken the first slot, XLU. And as we know, both of those sectors are fairly lightweight and they are more defensive in nature. Down at the bottom of the barrel, we see the XLF for financials down 1.09%. And again, if you wanted to use as measured from today's open as the true winner, you would get the communications sector, another heavier weight risk on type sector, which leads me to my next point, which is just that we continue to see defensive posturing in our sectors in the marketplace here. We will look at our ratio grid that we brought up on the weekly watch list video on Sunday, but for now, let's stick to the plan. Let's cover the heavy-weighted sectors first. So the XLK for tech, the heaviest of them all, down 0.44%. XLF, we already covered, second heaviest that we're watching, down at the bottom of the barrel, down 1.09. And then the XLV for healthcare, the third heaviest that we're watching, down 0.97%. So again, the defensive posturing continues to remain in play here. Note that the staples are also listed up at the highs. The only thing that was sort of a saving grace, and this is just as measured from yesterday's close, is the fact that the XLY, consumer discretionary, was skewed towards the top of the list, but look at how it's measured from today's open, clearly a down day. So let's check in on some of these charts and just make note of where our structure is, where the risk is. I certainly think that the XLK chart tech is concerning at this point in time. Notice there was no support at this prior structure here as we started to move towards it. Obviously, we had the gap down on Monday, and today we have an outside bearish engulfing bar. That, of course, has to induce some bearish sentiment here, noting that we failed to hold this move into the gap overhead. We retraced through the entire prior day's structure and closed weak dead on the lows. So to me, the risk is the downside here in the XLK. Continuation lower, obviously continuing to be a drag on our S&P 500. So this chart is not looking fantastic. The next sort of inflection point would be if we come all the way down for the 100% retracement of this move right here, we would watch for some sort of dead cat bounce and see if we form an equal low, and that's clearly where a breakdown could come from. So that to me is the major risk as of right now in the S&P 500. We'll talk about the SPY itself in just a moment, but the XLK, the largest component of the whole thing, does not look promising at this point in time. Let's continue and talk about the XLF for financials. Obviously, getting back down underneath that 3750 pivot. This little dead cat bounce did produce a lower high, so you can clearly see, this to this to this. An equal low reattempt at this area, which we are currently getting, could easily lead to the flush, which takes us closer to 3550. Again, another risk-off bearish indication for the S&P 500. This bounce did not amount to anything in the bull's direction, so fairly concerning. The two largest sectors that we're really watching the push and pull between are both indicating, hey, look out below, right? While we're talking about financial things, let's quickly take a look at rates. Again, this, I believe, is slightly decoupled from what we're seeing in financials at this point in time. They continue to scream to the upside. Just be aware that as rates continue higher, there should be some benefit to the financial sector, but clearly the price action does not lie, right? The main thing I think we should actually be paying attention to in financials, aside, like rates aside, is obviously earnings, right? JP Morgan is going to kick us off before the bell on tomorrow's session, Wednesday, and then Thursday before the bell, we'll get the bulk of the companies. We'll get Morgan Stanley. What are the other ones here? Citi, Goldman, all those guys will be reporting as well on the Thursday morning session, and whether or not those gap up or gap down based on, good guidance doesn't really have to do with the earnings. It has to do with forward guidance, right? That should be pretty telling for our XLF. So Thursday morning will be a big inflection point probably for our XLF. And keep in mind, if we crack 3750, look out below, right? 3550 is the next level of support. And obviously that's a bearish drag on the S&P 500. Let's quickly take a look at the XLV. We're also going to take a look at the XLY in just a second here. And then we'll get on over to that ratio chart. So in the XLV, healthcare, you can clearly see a more aggressive pullback, but we know it's been okay. Basically there's been some relative strength here. It's the only one that was relatively strong to the S&P 500. Now that we're starting to see some pullback, the question becomes, how deep is the pullback? Now, ideally, keep in mind that the XLV has been giving us break retest, break, retest, break, retest. Is it going to support at this prior breakout level, 139, 138.80s? That's what we have to determine into the end of the week. If we start to turn here, obviously that's a good thing for the S&P 500, but please keep in mind that the XLV acting alone is not enough to push your S&P 500 higher. And that, we have clear evidence of that. As this has been moving higher, the S&P has obviously been pulling back. As this pullback is unfolding and these, other heavy-weighted sectors are not in gear to the upside, that's when your sell-offs start to become exacerbated and, really obvious in the S&P itself. Okay, so that's the sector interplay at hand right now. Again, we will quickly take a look at the XLY because it's such a heavy weight in the S&P 500. And the main thing I wanted to note here is, again, the failure to hold this prior neckline right here, this daily structure. You can clearly see on the pullback, we're starting to get some price acceptance underneath. On the Monday session, we did fill that gap. And today, again, we have the outside bearish engulfing bar, not quite as weak as what we saw in tech with the close underneath yesterday's low, but nonetheless closing low on the day's range overall. So this is fairly concerning. Price acceptance underneath 179 in the consumer discretionary sector, which again leads to a more risk-off environment. So with that being said, let's quickly hop on over to our ratio charts. Again, if you're not familiar with what this is, we talked about it on Sunday. It's meant to be read like a book from left to right and from top to bottom. And it goes in order of the heaviest weighted sector all the way down to the lightest weighted sectors down here, the XLU, okay? So the big ones that we want to pay attention to are these big four up here, and these are the exact charts that we just looked at. If the SPY is going to catch a reversal from this pullback, you need to see these lines start pointing in the upward direction. So again, how many are pointing upwards right now? The XLY, a little bit of relative strength, just noting it wasn't quite as weak, closing dead on the lows like the SPY did. But look at the XLK, pointing lower, right? The XLV starting to curl lower off of the pullback that we're starting to see, and XLF financials here started to make that return higher, but it's already pointing back to the downside. So overall, the ratio chart is indicating, based on these four, the big four, kind of still in that risk-off environment. There's, we at minimum, need two of the four pointing in the upward direction, and we don't really have that at this point in time. It would be helpful if it was the big two, so this one here and this one here. But overall, I mean, the only thing pointing higher slightly is consumer discretionary, and even that is underneath a declining 50-period simple moving average, okay? So overall, sectors are continuing to support the theory of risk off. You can see the XLP for consumer staples, which is a risk off defensive sector, is pointing higher. Again, so think about that in the inverse, right? Same thing with energy, pointing higher here. Real estate starting to curl higher as well from a mild little consolidation period here, and the same thing with utilities, curling higher at the very bottom. So overall, the look in the sectors does not look promising here, and hopefully, through walking through some of those charts, you're able to identify what we need to see hold as or potentially reverse as we go into the remainder of the week. So with that being said, taking a look at the SPY chart itself to determine what we can expect into the remainder of the week. The first thing I would point out is that we had a 3-day balance. Obviously, it resolved to the downside, and we hit our target. Remember that we're usually looking for a range double. That range has doubled. We have fulfilled that particular trade. We also know that 437 is a pretty important level based on prior structure here, a low here, and an intraday pivot from the first major area of balance that we saw on the initial sell. So 437 carries a lot of importance right now, and the question becomes, how will this resolve into tomorrow's session, into the end of the week? Now you'll notice I still have some of these other lines on our charts. Where are they coming from? What are the significances of those lines? Let's go ahead and go on down to a 30-minute time frame. This is really going to help make our job a little bit easier. So obviously 443.50 is the bottom end of the range. You can see we looked let me go back to a daily. Getting ahead of myself. Let's talk about it from this perspective first, just because it might make a little bit more sense. Whenever we're dealing with a range, right, there are a couple of possibilities. Obviously, the breakdown to double the range, breakout to double the range, but what are the other ones that we talk about, right? The look below and fail and the look above and fail. Technically speaking, early on with the CPI data that came out and the market rallying, we had a look below and fail. We were opening right on the bottom end of the range, right? And we even started to rally into that 3-day balance as the market started to open up. So technically speaking, we had a look below and fail. That is a bullish trade. You're looking to target the top end of the range. Did that work out? Obviously not. And we fell back underneath the opening print, and that's where this level comes into play, around 441. So now let's go back down to the intraday charts here. This is a 30-minute time frame, right? So you can see we get back down into this consolidation, and as we break that level once again, that's where the selling really picks up. So going forward, if this chart is going to reverse off of 437, I'm talking very hypothetical technical here, obviously things are pointing to lower currently, and the sectors are supporting risk off. I'm talking about hypotheticals. If we're going to reverse to the upside, the first sign of strength would be recapturing that breakdown point from right here at 441. If we can put in a higher low above that, the next trade would be back above 443.50 to once again attempt that look below and fail on the 3-day balance from right here. If we can pop back into that range, especially after a higher low, I know it's a really sloppy look, but if we do something like this, correct, just think about that. There's your neckline break of an inverted head and shoulders, and it's back higher into 450.25. That's if we catch a reversal into the latter half of this shortened trading week. I'm not saying it has to pan out that way. I'm talking about the structural elements that I would be looking for if the market starts to reverse in the first place. As we know, the look is for lower currently based on everything we're seeing. So that being said, underneath 437, what do we have? Not a whole lot, right? We could technically rotate all the way back down to 428.75, call it 429 area, and the daily support trend line. I think that would be a little bit aggressive. It wouldn't be my first thought into the end of the week, just because it's, that's a pretty substantial move on a shortened trading week. I believe the expected move for the week was literally to this area right here, and we've obviously hit that. So I don't think the market's pricing that in, but we'll see. If we do move lower, if we get price acceptance underneath 437 and we do something like this, lower high underneath, this is your target down below, 428.75. Based on the positioning of the sectors, I believe that the market has the possibility to move lower, but it's not necessarily the trade that I'm looking to take advantage of. Again, you can call me crazy for still trying to find bullish scenarios in a falling marketplace. That's fine. But to me, again, it keeps on being like they're dangling the stick in front of us to the long side, and it doesn't pan out with the CPI move, with breaking back into the 3-day balance, with the selling on Monday being extremely muted, right? It was really just balance back and forth in this section of the chart. To me, it's pretty difficult to play the downside right now, at least in my opinion. And maybe that's just my own psychological burdens, but nonetheless, that's what I'm seeing on the charts. Hopefully that was a useful interpretation. Let's quickly take out the Fibonacci's and check in on where we're at. We're at the 50% mark. We know the 61.8 can act as a line in the sand. We'll see what happens, right? If we crack underneath 433.50s roughly, then that's where you get that stronger opportunity to get here, if not further, towards that 100% retracement. Again, that I wouldn't expect this into the end of the week. That's not what I'm saying, okay? We talked about bull scenarios. We talked about bear scenarios. Let's quickly flip on over to the market internals. I will have to quickly load up that screen here. So bear with me for just a second as I adjust these charts to come into view. That's good there. And then lastly, the tick. Good. And then we'll just throw on the clean drawing set in our futures. Look at that. Perfect. It's like it was already loaded. So anyways, what do we have in our internals? What are they telling us about the marketplace? Well, on the Monday session, as we got that really neutral day, we had exactly that, really neutral internals. I suppose the AD got bearish there and the ticks were fairly bearish as well. But the volume, it wasn't like it was massively flowing out of the marketplace. I think the worst of the reads on the Monday session was just your cumulative tick here. You can see hardly any of the action was above the zero line. So that was kind of a bearish indication. What did we see on today's session? Again, out of the gates, strong volume. If you were watching the breadth readings, they opened up at like 3, 4, 5 to 1 positive. Obviously, as the market sort of tried to rally on that open. I mean, it didn't hold, clearly, but we didn't make it to significant reads. Right? Usually, we're looking for 300 million, positive or negative. We did not make it there. It was about half that on today's session. In terms of the advanced decline line, again, here's another pretty bullish indication. Opening and holding above 1,500, usually that's a trend day. It didn't unfold that way, unfortunately, and obviously, we came back down to the zero line. So again, a little bit of divergence there between what actually happened in the market and what was going on with the underpinnings of the NYSE, essentially. Same thing with your ticks. Notice that as we were sort of chopping around here, the ticks were extremely muted. There was no low tick of the day as we started to come into low of day and break that until really about here, 12:30, right? So as we made this move, that's where that new low tick came in. So, to me, this muted activity, it didn't really lend itself to, okay, it's an aggressive short on the breakdown of the low of day, right? It wasn't setting up that way. So to me, I'm not really seeing the chart as, bearish as it clearly is out there. And again, maybe that's my own psychological shortcoming, but everything in the internals would sort of point to more neutral and not necessarily such a, aggressive downward spiral that we've kind of been on over the past couple of days. So that's what we've got from the internals interpretation. Let's quickly get on over to our market profile. And again, again, I probably put the video up in the top right-hand corner while we were on the internal screen, but if you don't know what the market profile is, I've got another video for you in the top right-hand corner. It's going to explain what it is, some of the terms we're about to use, all that good stuff, right? What do we see here? You can clearly see how it's an outside day, right? In complete engulfment of the prior day's range. Here's another indication, right? What happened on Monday was that we had a spike into the close and we opened well above the spike. We opened here. We actually opened well above this high volume area as well on today's session. So to me, we were negating everyone who was short late to the party on Monday looking for that move higher. Obviously, it didn't result that way, but that's what the indications were early on the morning session with that CPI sort of boost higher. Nonetheless, going forward, what do we need to pay attention to here on the profile? We have a double distribution, okay? And by double distribution, I mean we have this up top and this down at the bottom. So ultimately, tomorrow's session will be determining, do we accept in the lower or upper distribution of today's double distribution day? Obviously, if we move underneath, that's an even more bearish indication. If we accept here, that's a more bullish indication. And here, I would start saying more neutral, right? So that level and the levels that you want to watch are the single prints that separate the two areas. So if I just expand the chart a little bit, let me illustrate those numbers for us here. So 44.1950 is the top end of singles, and the bottom end of singles is 44.1325. All right, so in between here, treat that area as a gap, right? There's very low liquidity. You can see how low the volume was in there. If we come up into it, your first indication is, can we resist off the top of this or bottom of the single prints, excuse me. Then the second attempt, okay, look for that gap, quote unquote, single print area to fill. Right, that's a trade in and of itself. And then that should also act as resistance right here as we come into that next area of structure where the volume starts to pick back up to quote unquote normal, right? So again, just to illustrate and tell you those numbers one more time, that's 44.1950 down to 44.1325, all right? That's what I would be thinking about during tomorrow's session from a profile perspective. You can also see that the point of control was left high up in the session. And this isn't like a spike here, but it was really a late day sell that did produce the secondary distribution. So again, just start thinking about, okay, point of control was left higher. If we can move to the singles and through the singles, that should probably act as a first target if the move is bullish, right? And we also get that structure that unfolds, just like we talked about on the SPY itself, all right? So that's a pretty, I suppose it was a pretty biased interpretation of our, well, maybe it wasn't a biased interpretation, but you can probably hear my frustrations, right, on what the market's been giving us over the past couple of days. And I suppose it is what it is. You got to deal with the hand you're dealt. So nonetheless, continuing on here, hopefully I've still got some of you guys viewing and you didn't all tune out. Nonetheless, QQQ, NASDAQ 100. What do we see on this chart? Same exact thing. More of an aggressive pullback. Obviously, we fell right out of that 3-day balance. Engulfing day on today's session has some pretty bearish implications. Your target underneath is 335. If we quickly take out the fibs from the lows up to the highs, you can see we're sitting on the 61.8. Obviously, a little bit more room to go until we get to that 335. So I would really opt for structure, not blindly following the fibs. Ultimately, if we start cracking that level, 100% retracement becomes highly likely. We've also noticed across some of our core list of companies that we haven't been seeing any turnarounds yet, which obviously is a pretty big drag, noting that many of these companies are tech companies, right? So with that being said, the QQQ does look weak. It does look like it could have further downside. It will have very similar sort of structure areas like the SPY. So if we just drop on down to that smaller time frame here, you can clearly see this is that level, right? So the first thing you would want to see this do if it's going to turn around in the first place, and again, it does look bearish. Don't misconstrue these scenarios as, you know, me ignoring the fact that these charts look bearish. The first thing you would want to see is something that does this, a higher low above 343.70. If that can happen, maybe we can shift our bias for the look below and fail on the 3-day range, which we know is up here. Again, you probably wouldn't be trading for this gap to fill anymore. You'll notice we got little acceptance into it, but nonetheless, the long entry after you confirm a higher low above that number would be here at 348.50s to rotate back up towards the top of the range with the possibility of a bump in the midpoint of the range of 50%. And again, we're not going to get too nitty gritty here. Technically, the number is 353, but we'll take it in stride if we get there in the first place. Remember, that's only in play if we do something like this, okay? If we can't do that, then obviously you want to watch for shorts, so any lower high underneath that level, or even more ideally, you could do something like this. I know we're getting pretty crazy with the lines on the screen, right? But anything that does this and resists off of this prior shelf of support, which then offered the flush into today's afternoon session at 342, that could also be an indication for a short right? And then you're looking for a breakdown of today's low of day for follow through into and closer to that daily 335 level that we just mapped out, all right? So that's your QQQ in a nutshell. Let's get on down to the IWM Russell 2000 and the small caps. We'll take a quick tour through the core list of companies, and I've got 3 additional trades for you. So what do we see in IWM? Currently in a much more balanced state than the rest of the broad market. We know that this is still a risk-off look, though. Obviously, we are still firmly underneath that 204 neckline of the head and shoulders here. There's no reason to be thinking that this is screaming risk on for equities right now. It's just as bearish of a look. Obviously, this one has more of a potential to break down and be an easier trade to take advantage of because we have not flushed the lows of the balance yet, which are currently around 196.50. If that breaks, you're looking for the lows here around 193.50 and then the bottom end of the range. Remember that this big fake break of 208 is really, what set off the bearish momentum here inside of IWM. There's really nothing to do to the long side in IWM until you recapture 204, something that does that. Maybe that's more promising for a second attempt of that weekly structure. Just as a reminder, we'll take a quick look at it. Here we go. So again, if we get a higher low above 204, maybe you get a second chance for something that does that, but currently that's obviously not what's in play on the daily time frame. Big inverted hammer on today's session. It's not quite an engulfing bar. We did set a significant higher high, but we did not set a lower low. Instead, again, your short here is a breakdown of 196.50s to get into this double bottom right there. And again, this is just going to echo and ring true with the risk-off sentiment that we've been discussing that our sectors are also sort of confirming. So that is our broad market. Let's get into our core list of companies quickly here. Then we'll dive into those 3 trade ideas. Apple, indecisive bar. Longs, only if we can recapture 169 with a higher low for something that does that. And you're starting to target the top end. It's at the top end of the 3-day balance, and it's the gap area, okay? So that's your long in Apple. Indecision bar, higher low, higher high on today's session. Really tangled up at that 50 SMA. Not overly convicted one direction or another, honestly, here. If we drop it down to a 30-minute time frame, what you'll notice is we did support off the top end here and the initial low as we came in on the open, right? So to me, 167 needs to continue to hold. If it does, again, higher low off of 169 gets us back to the top of the 3-day balance up here, 173.62. On the daily, we discussed that. To the downside, your better flush is underneath Monday's low, roughly 166 to get into 163 to the downside, prior highs from here, and a little bit of support from that candle there. Continuing along, Netflix is up next. Much more of a bearish chart than what we just saw on Apple. Obviously, you get that engulfing bar, bearish engulfer on today's session. We're looking for lower into the bottom end of the range. That will be a 100% retracement. When and if we get to 332, expect a bit of a dead cat bounce, and then maybe after a lower high and then equal low attempt, that's where it can flush, right? Obviously, earnings are going to be around the corner, first on Netflix. They usually report early, so that's something to be mindful of as well. It's not this week, but next week, all right? So Netflix is going to kick off earnings season. Currently a bearish look with the engulfing bar, looking for lower. If it's going to turn higher, got to see it up above this level here, 362.34. And again, if it does something like that, maybe that's your trade here for a new long, and you're looking for a back test of this balance. Again, not overly convicted inside of Netflix to the long side. Tesla is up next. What do we see in Tesla? Filling the gap overhead, closing weak as an inverted hammer. I would watch for the 2-day flush. So if we break this level here around 980 roughly, just for round number's sake, we know that 945 could easily be in play. If we scrunch up the chart just a little bit, you'll remember it was a big breakout area from in here. Boom, that led to that. So any retest of that, I would watch for this area to turn into support. Considering we have not tested it in quite some time, it would be a big break and retest. So 945 is the must watch to the downside in Tesla. Again, it does have a bearish look with the inverted hammer, 2 equal lows. If that flushes, 945 is on your radar. To the long side, I would want to see something like this, a higher low back inside of this 3-day balance above 1022 before starting to fish for new longs. And if it does come down to 945 and print a hammer, maybe you could look for longs as we come into that area. If we get some sort of reversal bar or an intraday double bottom at that area, 945 is not something that you want to, or at least to me, it's not something that you want to be looking for new shorts through. That's where you would reevaluate for a reversal back to the upside, right? So that's Tesla. Continuing along, AMD. Firm outside bar, engulfing bar on today's session, underneath 100 on the little bit of a back test that we saw there. Got to the 95 target. Again, this chart looks bearish. There's no way around it. Big breakdown of the weekly head and shoulders, right? Remembering that we had something that did this. You could call it a descending triangle. We talked about this in the weekly watch list video. So underneath 95 opens the door into 85. Obviously a bearish look here inside of AMD. If it's going to be long, it's got to be a higher low above 100 for some sort of retracement back closer to 106. Currently doesn't look like a likely scenario. Continuing along, Facebook breaking my heart today. You guys know that I had a position in Facebook and it's finally given up that 217. The position does have a 3 to 5. Oops, that's a really ugly 3 to 5 year outlook. So I'm not ready to just cut it. You guys know that I was willing to add closer to 185 or excuse me, 174 was the level. We never got there. So ultimately, I'm still holding on to it, but I did want to be transparent about that, and we are breaking 217, and that's obviously a bearish indication, right? So it's not good for the position, but we got to stay as objective as possible here. So bearish outside engulfing bar on today's session, breaking 217. We had a fair bit of consolidation, and now it looks like there's some room to run to the downside, right? It's as simple as that. Your next target underneath is going to be around 203.50. For longs, I would want to see something that does this. So recapture of 217, a couple of higher lows, and then we know the best long opportunity is really up and over 225.50 for that gap overhead, noting that there's thin structure there. Let me just illustrate that one more time. Again, could there be possibility for some trade that looks like that? Yes. But I mean, think about where the easiest long is produced. It's not really trying to bottom fish and get, through here. It's really let the market prove itself. And then if we want to come up to that 225.50, that's where you can break through thin structure. Look at what we have here, right? So that to me is the higher conviction long. If you want to go bottom fishing around 217, that's fine. That's your prerogative. But currently, this is a bearish look with the outside bar, bearish engulfer, right? NVIDIA up next. What do we see in NVIDIA? Clearly, outside bar, bearish engulfer. I know I sound like a broken record, but obviously this is also pointing to how the QQQ hasn't really supported at any of these levels. As the big players in tech have pulled back, obviously that's a huge drag. So currently looking for a reaction at 110 because this has given us basically the full 100% retracement. I would not be looking for new shorts inside of NVIDIA. Instead, I would be looking for any reason for a bullish reversal to take place. If you come down and print a hammer candle on Wednesday session, then take out the high on Thursday session, that's a long reversal, right? Up through the high, stop goes underneath this 210 area. Not, these candles aren't literally depicting that the low has to be at 200 and the break has to be at 215. That's not what I'm getting at. I'm just illustrating it for illustration's sake, exactly that. So if we can find a reversal off of 210, that looks good and strikes me as healthy for some sort of dead cat bounce. I wouldn't overstay your welcome, right? So just because we're looking for longs at this area doesn't mean that we're assuming that it has to do something like this. We're just looking for it to come into prior structure. We're going to take off a majority of the position, 3/4 maybe, and then trail stop the last quarter as it potentially moves higher, if it moves higher. If not, again, trail your stop higher. That way you lock in some sort of profit and the trade doesn't go red, obviously. Okay, so NVIDIA really looking for the reversals around 210, not looking to initiate new shorts based on location here. Next up, we have Microsoft. What do we see in Microsoft? Breaking down, it's not an engulfing bar, but nonetheless lower high, lower low, and we are underneath this area of structure right here. If I just quickly go on down to the 30-minute time frame, you'll see the similarities as to what we were just discussing in QQQ and SPY, where there's that technical level. There was no acceptance above. As we flush the prior day's low, that's where the sell really takes place. So any lower highs underneath here strike me as being bearish. Any higher low that forms above that strikes me as being bullish. And then if that happens, that's where you're looking for this gap to fill. So if this is the scenario, we put in a higher low above 287.75, I would start looking for this gap fill trade overhead. If we come in for a lower high, do something like this, we don't get any price acceptance above, that's where shorts can be continued. On the daily time frame, again, bearish look here. You're looking for ultimately a rotation to the bottom end of the range around 271.65. Last but not least, the beast Amazon, and then we'll get into those trade ideas. This one looks good because we have a 2-day flush point. It's technically balanced, right? We have 2 days, not an expansion of range. They're overlapping. As long as you remain underneath 30.55, let's quickly go down to the 30-minute to illustrate that. You can see it's a little bit sloppy here, but nonetheless, it's that same sort of idea. Here's your resistance from the prior day, acted as early morning support. As we crack it, that's where the aggressive sell comes in. So anything that remains underneath for another lower high, here to here clearly, sets up the breakdown of the 2-day flush point, and that should take us at least, at minimum, into that 29.80, if not slightly lower. I wouldn't imagine that we put in a bar that looks something like this into the end of the week, but ultimately your next structure is 28.20 inside of Amazon. The reason we're leaning bearish on this one, remember that 31.76 was an important weekly level. It has been given up, and there is no turning back from here, right? At least as of right now, it does not look that way. Clear breakdown underneath, weak close. We did fill the gap overhead. We did not get any acceptance into the prior weekly range, and we're back down down at the lows. So we are looking for lower inside of Amazon. And again, with the 2-day lows stacking equally, it's got a nice little setup here to break and continue on lower into the remainder of the week. So that's our core list of companies. I know it's a pretty long video today, but I've got 3 more for you. Walmart, WMT. What do we see here? A big break and retest of this prior resistance around 152. So resistance, resistance, 2 inverted hammers right here. It breaks. Now we're getting the retest, right? So we would classify that as a break and retest. It's certainly so there's your break and retest, right? Looking for higher. It's certainly also a reasonable pullback in a bull move. If I do something like this, right at the 38.2. So to me, this is starting to form a bull flag. Anything that, consolidates out in here, fantastic. Looking for the break over time for continuation moves inside of Walmart. We also know that the XLP, consumer staples, is extremely strong right now. So again, it just makes sense that you would look for longs in that sector. And Walmart, beautiful setup here with the break and retest. 152 needs to hold. If we start printing hammers down here, looks promising for a reversal up and over the highs to get into there, and then we will monitor for continuation. If you're more conservative, you want to see something like this happen, a higher low, fine, break of the highs, takes you higher, right? That's Walmart. Next up, we've got BA for Boeing. What's going on in Boeing? Just a simple consolidation area. Let's clear that, and then we'll start from scratch here. So you can see we've got, let's try that one more time with the right tool. Zooming in, you can see we've got equal lows, equal highs, inverted hammers back to back, right? Failure of this hammer to produce anything as we cross through the high. So now the flush is underneath the lows around 174 to take you into this area right here around 169. So that certainly could set up into the remainder of this week. It's also, roughly speaking, based on range rules, about a range double. So that's the downside here. If you're intent on playing it long, that's fine. You're looking for the break of 178.57 to probably come up and fill the gap. If it goes further than that, my next target would probably be closer to here around 190, noting that you had thin structure on the way down, but overall in a down marketplace right now, and we also know BA is trending to the downside overall, it wouldn't be my first thought to be fishing for longs out of this balance area right here. So that's Boeing. Next up, we have Nike, and lastly, obviously, NKE. Oops, let's get a K. NKE, there we are. And this is more similar to what we just discussed in Amazon, with 2 equal lows forming a flush point, obviously 2 inverted hammers falling out of a 3-day balance right here. It strikes me as bearish, right? So looking for the 2-day lows to break around 124.35. First target would be the top of the gap here around 122, and then the second target would be the gap to fill at 120.41. All right, so looking for a break. First target, second target, stop could go right above, or if you want to give this one much more room to breathe, if you're more of a swing trader, you could put a stop up and over the highs here, start to target that as your first target, and then monitor for continuation as we move into pretty new 52-week lows, right? So that's what I've got for you in this crazy market out there. Obviously, you can tell through the tone of my voice and the video here, it's been a tough one for me at least to interpret to the downside. Nonetheless, trying to stay fluid here, trying to shift my bias when we need to, and with that being said, I'm going to wrap up the video. So if you enjoyed it, let me know in the comments section or by giving the video a thumbs up. Don't forget our secondary channel is linked down below in the description. And with all of that being said, I wish you a green trading week.